Hi class, this video is going to focus on chapter 22 of our textbook, which is all about how we account for non-current assets. Remembering that non-current assets are assets that we control, but we expect to control them for more than 12 months before they are converted into cash. What are we going to cover today in this video? We're going to cover how we determine the cost of these assets, which is a little bit more complicated than you might expect. And then importantly, as you can see on this slide, the important topic of depreciation. I hope that you, by the end of this video, understand what depreciation is, how to calculate it, and how this concept of depreciation impacts our reports of the income statement and the balance sheet. Before we do this, we need to consider what I mean by the cost of a non-current asset. It is more complicated than a number of things that we often look at in non-current assets, where we just look at a purchase price. When we acquire a non-current asset, we must determine its costs. And before we do that, let's have a think, what are these non-current assets? These are things that we're going to hold for more than 12 months, such as vehicles, vans, computers, shop fittings, buildings, anything like that. So incredibly important assets. Now, to determine the cost, we're going to look at a number of concepts. Not only are we going to look at the purchase price, but we also should value our non-current assets at its purchase price and then add all the other costs incurred to get an asset into revenue earning capacity. That's a lot of technical term and important to understand, but essentially what is all the costs that a business needs to incur to get this asset into a location and condition where it can start to be beneficial to the business and earn revenue. Some of these examples include freight in or cartage in, so the delivery of the asset into where it is going to go. So if you see the word in any of your expenses, it is going to be added to the cost price. Modification and installation costs, so modifying it somehow or installing it. Any other sorts of expenses such as custom import or stamp duties, these are often taxes that we must pay to get our asset into a condition to be able to use, or any other buying expenses. What do we not include? We don't include recurring costs. These recurring costs are often commonly insurance or maintenance, and I call them recurring costs because they occur year to year. These are not considered as part of the cost of an asset because they're not to get the asset into revenue earning capacity. These are just costs that we use to maintain each year this asset. What else do we need to remember? GST is not included in the cost price. And if we do all these things, we are going to tick off a number of qualitative characteristics. These qualitative characteristics are relevance. So if we do this, we have an accurate cost of our non-current asset, which means we can make good decisions. And also we will faithfully represent the information accurately. So let's look at an example. For example, a computer system was purchased for $10,000, so our purchase price, and we know a computer is a non-current asset. And experts were employed to install the system, and this cost an additional $2,000. The system was insured at a cost of $400 per annum. The question is, what is the cost of this non-current asset? I hope by following the previous definition, you've worked out the cost is $12,000. $10,000 for its purchase price, and then an additional 12 to install it because it will not be able to earn revenue, be useful to the business until it's installed. The insurance cost of the $400 is a separate expense. It's an recurring cost. Per annum means we must pay it every year, and it's not important to set up to start to earn revenue. So how do we look at this? The cost will be $12,000. And this is the cost of the current computer system and the value of our non-current asset. We don't consider the $2,000 installation charge as a separate expense, It is just a cost of the asset. So now it's your turn. What is the historical cost of this asset? A business that has bought a new vehicle for $20,000 cash, but it then must pay stamp duty of $1,000, dealer charges of $500, and must pay insurance of $800. And also, what is the cost of this non-current asset? A new computer which we've bought for $10,000 plus installation of $2,000, and we have a service contract of $200 per annum. I hope, and you can pause this video, have a look at the detailed information, that you've determined the cost of the vehicle is $21,500. We add the stamp duty and dealer charges because they are one-off costs that we must pay to get this vehicle to be able to earn revenue, and we ignore the insurance and expense. It's still an expense, it still goes in our income statement, but not as a cost of our non-current asset. In our computer, our historical cost is $12,000. And I recommend to pause this video now and have a look at the detailed explanation of those. But that's the important aspect of the cost of a non-current asset. This is how we determine the original value. And this is so important because we now get into the topic of depreciation. And you'll understand why cost is so important once you understand depreciation. And I hope you leave this video going, I can answer this question, what is depreciation? So what is depreciation and why is it relevant to our non-current assets? Depreciation, in its technical definition, is the allocation of the cost of a non-current asset over its useful life. This recognizes that the value of the asset that we're using, that we have, a computer or a vehicle, for example, is used up each reporting period, and this reduces the value of our non-current asset. We understand that we are using some of the value of the vehicle each time we use it, each reporting period or computer. And this is inherently reducing the value of this asset to our business. So we inherently then do reduce the value of our asset by depreciation. What is this depreciation? It is a cost that we recognize as an expense. So each period, we're going to realize that a part of our value of our asset is used up, and this is an expense, and this is going to reduce our profit and give us an accurate profit figure, and we'll go through that in a later part of the video. Now, we in year 11 only learn about one method of depreciation, and this is called straight line method. If you continue into unit 3 and 4 accounting, you'll learn another method as well called reducing balance. Now, straight line method is the simplest of the two because it allocates the same amount of depreciation each period. Essentially, it's saying we use up the same amount of value of the asset each reporting period. So why do we depreciate? We know that depreciation is an allocation of the cost of our asset, and we know how to calculate that now, of a non-current asset over its effective working life. Now, this is unique to non-current assets because we know we hold them for many years. So it makes sense that we recognize each year that some part of its value has been used up. So why do we depreciate? What's the point of this? The purpose of this depreciation is to recognize that we're going to write off part of the cost of the asset against the periods that they are generating revenue. If we are using an asset to generate revenue, we are using up some of its value, and hence we should calculate this amount of value each reporting period. So we are marrying up how much revenue is earned with the expense to use up our asset to make that revenue. And therefore, depreciation is a really important expense. It should be considered under accrual accounting. And for those people with keen eyes, we know accrual accounting, accrual basis assumption is an important accounting assumption. where we must recognize expenses when they are incurred. And ultimately, this is important for faithfully representing our information. And maybe more important, it is very relevant for our decision making. We need to know what, in reality, how much of our asset has been used up, what is the actual potential value of our assets. So how do we calculate it? The formula for straight line depreciation is as follows. Depreciation per annum, so depreciation per year, is going to be the cost of our asset minus something called the residual value divided by the estimated life. The cost is what we calculated previously, the purchase price of the asset plus all of the other costs incurred to get the asset into earning revenue. So that is why cost was the first part of this lecture. Residual value is the estimated value of the non-current asset at the end of its life. How much is the asset going to be able to be sold for? What is its value at the end of its life? And then useful life is the estimated period of time that the non-current asset will be able to earn revenue in our business. And we measured this in years. So we're going to have an asset that is going to be worth something at the start, worth something at the end, and it's going to go down in value over the course of its estimated life. And this is why all three are important. And it is important to note that two of these are estimates. We are essentially guessing, although we become pretty good at guessing, what our residual value is, how much it is going to be worth at the end, and how long it is going to be useful in our business. Now, this is going to be relevant potentially in year 12. Important to understand that this is an important thing that we're doing, but it's one of the few things we do in accounting where we are estimating, potentially having a bit of a guess. So what are the key terms that you might see when doing questions and calculating depreciation? You might see the term depreciation expense, and this is the amount of the non-current asset that has been consumed in the reporting period. How much is the depreciation expense for that period? You might see the term accumulated depreciation, and this is the total depreciation for an asset at a point in time. So if we have depreciation expense of $1,000 a year, and there has been 3 years, that means we have accumulated depreciation of $3,000, 3 times 1,000. And the carrying value is another term you might see, and this is the asset value of the asset that is yet to be consumed. So if we continue with our example, if my cost was $5,000, and after 3 years I have accumulated depreciation of $3,000, my carrying value is $2,000. 5,000 minus 3,000 equals 2,000, my estimated value at that time. So how do I calculate it? Let's look at 2 examples. We have a formula, so let's look at this example. If the equipment cost $10,000, so we have a cost here, and an estimated useful life of $3,000, and it would be expected to be sold for $1,000 after its 3 years, we have the 3 inputs to work out depreciation per year. Cost of $10,000 minus residual value of $1,000 divided by useful life of 3 equals $3,000 per year. We're going to use up $3,000 worth of the value of our asset each year as we use this equipment, to generate revenue. We could also use another example in example 2 that might be a bit more complicated because we've got to work out the cost price. So in July, we purchased an office desk for $1,400. We had delivery cost of $200 and yearly insurance of $50. Its estimated life is 4 years and residual value of $200. Now we need to work out here that our cost price, the cost, is not $1,400, but $1,600. because the delivery cost is something that we must pay to get it into the condition to earn revenue. Residual value is $200, apologies, and we have it for 4 years. So it's going to be $1,400 divided by 4, so $350 per annum. But if we think about to example 1, which is this one here, let's think about how we use this example to report depreciation in an income statement, because it's an expense, and also what our balance sheet will look like because of this depreciation. So the income statement, as we know, is where we record revenue and expenses to ultimately calculate our net profit for our period. Now, depreciation will impact our income statement and our balance sheet. The effect on the income statement is that depreciation, as we now know, is an expense, and expenses get reported in this income statement. We're going to treat this expense and report it under the heading Other Expenses. So the very last listing of expenses. So it's not going to impact your gross profit, your adjusted gross profit, but it will impact your net profit. And it could look something like this. Our depreciation for each year in this case was $3,000 of depreciation under other expenses. And this means our profit is going to go down by $3,000 because of this depreciation. The balance sheet reports the value of our assets, liabilities, and owner's equity. The amount of depreciation allocated each period keeps adding up. And this is our estimate of how much value is left of our asset for the business. So we're essentially going to be reducing the value of our assets. So we are going to report this in our balance sheet to reduce the value of our assets and then ultimately our owner's equity, because remember, assets equals liabilities plus owner's equity. So in this same example, I'm still going to list my equipment each year at its cost price of $10,000. This was verifiable by a source document. Remember, depreciation is a guess, an estimate. But I'm now going to have a new heading in my balance sheet under non-current assets where I actually reduce it. And it's going to say less accumulated depreciation. And each year, this is going to increase by the amount. Now remember, straight line depreciation is the same each year. So after 1 year, we have $3,000 of depreciation, which means our asset is worth $7,000. Year 2, we add an extra $3,000 of depreciation because it accumulates, and our asset is now worth $4,000. And this then gets to the end of year 3, where we have accumulated depreciation of $9,000, an asset worth $1,000. And if you can remember back to the first part of this example, what was our residual value of this equipment at the end of 3 years? $1,000. Now this is important because this is important for decision making to accurately show what our estimate of our assets is. We don't want to overstate our assets and overstate the worth of our business. This is important, and the understanding of all of our assets as a business is really important. A good business should know what assets we have, the value of them, and have that information readily available to make good decisions. How do some businesses do this? They have a thing called an asset register. So some businesses have numerous assets. And if you think about some big businesses, they have hundreds of different types of non-current assets. Different vehicles, computers, display equipment, buildings, the works. So we need to keep a register of this. And an asset register will include details such as the cost, the supplier, if they need to get some new ones, or they have an issue with it, the estimated residual value, and the estimated useful life. They will also have other details such as registration numbers, insurance details, lots of information that they can use to make good decisions. And guys, I hope this video has helped you understand depreciation and the importance of accurately determining our cost. Now's the time to practice determining costs of non-current assets, and calculating depreciation, and considering how this will impact your income statement, balance sheet, and ultimately how this will impact your business decision making.